Are you frustrated with your stock picking results? Does it feel like no matter what strategy you go with, you always end up with a losing company? Many of us struggle between, do I go with a value strategy or a growth strategy? And both have their pros and cons, but there are some clever ways that we can get the benefits from both in a single company. People gravitate to growth strategies because if a company is likely to grow their revenue and grow their profits a lot in the future, then obviously that makes for a great investment. The stock price should go up with it. The problem with that is if a lot of people believe it's going to grow, then they can push the stock price up too much. They can push it up beyond its growth prospects, and now you've fallen into the growth trap. Now, there's also value traps. When I find a value company and it's undervalued, I'm thinking, hey, great, I'm going to get a stock price increase when the market prices this company where it should be, because right now it's below its peers in terms of price to earnings or whatever metric you're looking at. The value trap, though, is sometimes companies are priced down for a reason and they're not going back up. So how do I benefit from both growth and value in a single company? Most of us have heard the phrase, a rising tide lifts all ships. And the same is true with the stock market. If I can find a sector or an industry that is on the rise, then the companies in that sector or in that industry are very likely to be brought up with the rise of that industry. The second step is to find companies in that industry that are undervalued compared to their peers, and this mitigates both the value trap and the growth trap. It's not likely to be a growth trap because it certainly isn't overvalued, because by definition we found an undervalued company. And then number two, it mitigates the value trap because a company that is undervalued in a growing industry is less likely to fail. It's less likely to lose revenue in the future because it is bolstered by the rising tide. Now, it's not impossible. There's still the chance that you could fall into a value trap or a growth trap, but it's less likely. We're all about mitigating the odds of failure. So what industry am I looking at? I'm looking at the semiconductor industry. And there's lots of companies that are in this industry. You've got the companies that produce the chips, and then you've got the companies that manufacture critical components that allow those companies to produce those chips. So there's tons of options within this industry, and this industry is primed for a lot of growth. Right here, I've got the Deloitte 2025 Global Semiconductor Industry Outlook. So over the next 5 years, Deloitte predicts this industry is going to be up at $1 trillion. It's currently sitting at about 700 billion. That is almost a 50% increase over the next 5 years. This whole industry is primed for lots of growth. So the next step is, how do I find value companies within this particular industry? Now, in this case, I was clued in to a company by Reddit, which is rare. Wall Street Bets actually does good due diligence work from time to time. Yes, you have to filter through a lot of crap, a lot of jokes and memes, but every now and then you're going to find a diamond in the rough. And this guy, Virtual Seaweed, did a great due diligence piece on PLAB, which is Photronics, but the ticker is PLAB. AI semiconductor component play is deep value. So he gives a quick description. Photronics is a global leader in the photomask industry, which is a critical component of semiconductor manufacturing. Virtual Seaweed looks at the company's financials, talks about their growth prospects, which I'm going to look into on my own here shortly. But one thing that he points out that is interesting to me is for the tariff traders. He says Photronics is uniquely shielded. The company operates a photomask manufacturing facility in Boise, Idaho. So they are basically the only U.S. domestic photomask producer. And I'm going to go into their annual report shortly and look into where else do they have manufacturing. But first, I want to point out how I calculate whether or not a company is considered a value company. Some people will use price to earnings ratio. Some people will use earnings per share. There's lots of metrics that you could use. I personally like to use a discounted future free cash flow analysis to calculate the intrinsic value, or my projected intrinsic value of the company. The reason I like to use free cash flow is because free cash flow is the chunk of money that a company uses to return value to shareholders. They can use that money to pay off debt, to acquire other businesses, to expand their operations, to pay a dividend, or buy back shares. So I like to track this chunk, how much the company is projected to grow that chunk of money, and compare that to their share price, along with a reasonable discount rate. And I do all of that on my automated spreadsheet right here. All I have to do is type in the ticker. The spreadsheet automatically pulls a bunch of information from stockanalysis.com, does the calculation for discounted future free cash flow, and then gives me intrinsic value calculations based on the analyst's future projections for revenue. All that information comes from stockanalysis.com right here. So Photronics is currently trading at $18.70. If I go to the forecast tab right here, I can scroll down to the analyst projections for revenue growth. Now, normally analysts will predict 5 years out. Unfortunately, in this case, they're only giving me 2 years of projections, but I've got a high, average, and low. The highest analysts are projecting 6% in 2025, 11% in 2026, and then the lowest are showing a revenue shrinkage of 1.6% and then small growth in 2026. The key to calculating or projecting the future free cash flow is to start with a decent projection. If I put in garbage, then I'm going to get out a garbage prediction. So I like to start with the analyst projections. I like to also use the company's own forward revenue guidance. And then finally, I like to look at what is the sector's projected growth rate. There will be periods of growth and expansion where new photomask technology is rolled out. There's going to be lots of buying, and then there's going to be a period where that buying is going to slow down until there's the next big development in the photomask industry. So we see a little bit of cyclical revenue growth and then shrinkage. Even though semiconductors are projected to increase 6 or 7% every year for the next 5 years, we might be on a down cycle for the photomask industry specifically. And I want to look into a little bit more evidence that showcases that. Here I've pulled up the annual report from Photronics, and the overview section, if I scroll down just a bit, I can see capital expenditure schedule for the next year. So in 2024, 2023, and 2022, their capital expenditures was $130 million in 2024, $131 in 2023, and $112 in 2022. However, in 2025, they are projecting to spend $200 million. This is over a 50% increase in capital expenditures. This is a strong signal that Photronics is confident in the next cycle of photomask. They are investing big money into capital expenditures, and this is going to be the expansion of plants and the upgrade of their equipment in order to manufacture the next level of photomasks. The next item I want to point out on their annual report is the location of their manufacturing facilities. They have 3 that are owned in the US. They have 2 in China that are owned. They have 3 in Taiwan, Germany, Korea. The trade war is not likely to be a good thing for Photronics, but at least they are positioned in a good spot with 3 manufacturing facilities in the US and 3 in China, which is where the highest tariffs are likely to be unless we come to an agreement. Next, I want to go to their investor presentation, where they talk about their forward guidance for the next quarter of 2025. They're showing revenue between 208 and 216 million. Let's compare that to their 2025 first quarter. So on stockanalysis.com, if I go to the financials tab, look at their income, I can set it to quarterly. In Q1 of 2025, they had 212 million. If their revenue in quarter 2 is 208 to 216, the company is projecting pretty flat revenue for the next quarter. But over the next entire fiscal year, the analysts are projecting moderate growth, and that is shown right here in the forecast. Even though the next quarter seems to be slow, the average analyst is projecting 2.6 revenue growth for the fiscal year of 2025, and then that growth is projected to accelerate into 2026. When I calculate the intrinsic value using the future free cash flow, I typically like to take 5 years of analyst projections of future revenue. I multiply that by their historic free cash flow margin. Free cash flow margin is the percentage of revenue that a company is able to create free cash flow. So I take the margin, multiply it by the projected revenue, and then that gives me analyst projection for future free cash flow over the next 5 years. I then use a flat rate of increase for the 5 years after that, and a flat rate of increase from 10 years into infinity. And those rates can be seen right here. So the next 5 years, years 6 through 10, I'm assuming 3% growth. This is just equal roughly to inflation. And the same for the perpetual growth rate, 3%. Now these 3 projections right here are the analyst projections, and they're already looking really good. Oh, and I just realized I skipped a step. For the analyst projections, they only gave 2 years. So I had to put in my own estimates for the next 3 years. So I tried to just give a pretty tight range of high, medium, low, 5% growth, for 2027 through 2029, 3% growth for average, and then a 3% decline in revenue for the lowest projection. So just be aware that these black numbers here, these are my own projections. These are the analyst projections. Those projections can be visualized right here with this graph. You can see the highest analyst projections show the revenue increasing and the lowest show the revenue decreasing. So even with that decreasing revenue over the next 5 years, if I then assume 3% growth after that, coming back in line with the next cycle of growth, and then 3% growth into infinity on average, the lowest analyst projection shows an intrinsic value of $31 per share. The current share price is 18. So that gives me a 64% upside. If the average analyst is correct, then we're looking at a 102% upside. I'm seeing huge upside potential with this company. I should also point out that this is including a discount rate of 9.43%, which I get that number from Alpha Spread. It calculates the cost of equity, which takes into account the risk-free rate, the beta, and the ERP for Photronics. It's basically taking into account the volatility and the risk with the risk-free rate, adding those together and giving me a reasonable discount rate that I can use. So the more volatile a stock, generally, the higher the discount rate that I want. Also, the higher the risk-free rate to make it worth it to take on the risk. So I'm using a 9.43% discount. The stock price is still 64% overvalued, assuming the lowest analyst is correct. I'm also assuming that the past free cash flow margin, this is 14.42%. This is the margin that I'm using. This is the average for the past 5 years. I'm also assuming that that average will continue forward. And right here, we can see a visualization of that. In 2020 and 2021, the free cash flow margin was low. In 2022, 2023, and 2024, it was high. So I'm just going with the average, kind of right down the middle. The next thing I want to look at is this adjustment right here. So I like to adjust the free cash flow by a percentage of the R&D, a percentage of the capital expenditures, cash acquisitions, and stock compensation. For R&D and capital expenditures, these two values are subtracted against free cash flow. However, some companies are benefiting from their R&D and their capital expenditures, and some companies are not. Some companies just have to continue pumping money into these categories just to stay up with the competition. I have decided to give Photronics credit for 20% of their R&D and 20% of their capital expenditures because a portion of these expenses are going towards growth. Why do I believe that? Well, if I go back to their annual report, they say right here, we intend to continue to make the required investments to support the technological requirements for our customers that we believe will continue to enable our growth. And they are spending $200 million in fiscal year 2025 for that purpose. Additionally, when I go to their annual report, their revenue is reflecting strength in the higher end photomasking capability, which is offset by the weakness in the older geometries. So once again, this is showing evidence of the cyclical nature of this industry. The older geometries are starting to fade, and now they are preparing for a boom in the newer geometries. That is why I'm giving them some credit for their capital expenditures. I believe this is going to be a critical part of their future growth. I'm also putting against cash acquisitions, which they actually don't have any cash acquisitions, so I can just go ahead and make that 0. And then I am counting against 90% of their stock-based compensation. The only reason I don't take 100% of their stock-based compensation against their free cash flow is stock-based compensation has some unique advantages over just paying your employees in straight cash. If your high-value employees are incentivized to make the company grow, then they're gonna, in theory, perform better. And paying your employees with company stock aligns their incentives with the company incentives. So as a result, I allow 10% of the stock-based compensation to increase the free cash flow, because normally stock-based compensation goes to increase their free cash flow. After all those adjustments, I'm showing a new free cash flow margin average over the last 5 years of 16.85, which is 2% higher than their current free cash flow margin that I'm using. So if I put a 2 into this category, it pushes up my intrinsic value even further. Now I'm seeing an 83% upside with the lowest analyst projections right here, and a 152% upside with the highest analyst projections. Now, in my mind, this is a little bit overly optimistic. So I want to plan for revenue reduction over the next 5 years. I also want to plan for a free cash flow decline over the next 5 years, because they are spending more money on capital expenditures, and capital expenditures goes against free cash flow. So because of that, I'm not going to give them any more credit. I'm going to try to be a little bit more conservative. I'm going to put a 0 in that box, bring it back down. I'm also going to assume 1% free cash flow margin decline every year for the next 5 years. And that can be seen right here. The red is the average. The yellow is the line that I am calculating. That brings my lowest analyst projection down to 21%. I also want to decrease the 5 years after that to 0%. So now the projection is over the next 5 years, we have revenue dropping a little bit every year in line with this projection right here, minus 1.1, up 1.2, and then down 3, down 3, down 3. And then the 5 years after that, 0 revenue growth, and then increasing with inflation. Even by dropping down all of those values, I'm still seeing a low analyst projection of 13% upside on top of the discount rate of 9.43%. So with the lowest analyst projections, this company still looks so good. The final thing I want to check is, does this company have any red flags? I have an automated Warren Buffett red flag checker. I read one of Warren Buffett's books on analyzing the financials of a company, and there are several red flags that he looks for in the company, and I have those automatically calculated right here. If a cell highlights red, it's a red flag. If it highlights green, then it's a green flag. It means the company is likely to have a durable competitive advantage. And then if the cell is white, then it's neutral. So I'm not seeing any red flags except for capital expenditures. Warren Buffett does not like to see a high percentage of capital expenditures compared to earnings. And this company is very capital intensive. So if they have one red mark, it would be their CapEx. But I'm willing to look past the high capital expenditure because they are going into a growth cycle and they have to invest a lot of capital into having the next high-end photomasking capability. So with that in mind, lots of green flags, 0 red flags. In these graphs, I'm seeing profit going up every year, earnings per share is going up every year. Their inventory is trending up with their profits, which is good to see. Their retained earning is always going up. That's good to see. Their debt is going down while their cash is going up. That's also a really strong indicator. And finally, their shares outstanding have been going down slightly over the past 5 years, but it's really over the last 3 years, it's been flat or slightly going up. So tons and tons of green flags. This company looks really strong. Normally, when a company is so undervalued, it's because they're not very profitable or they have lots of red flags, but I'm just not seeing it with Photronics. So I'm going to be investing $100 into this company. This is my YouTube investing portfolio series where I invest $100 into a different company every week. Now I quickly want to go over my existing portfolio. We started this series in December of 2024 and we have invested in 16 companies so far. Photronics will be the 17th company. We are currently about flat. We're down $50 in total on 1,900 invested. After I invest in Photronics, it'll be 2,000, and we have a money weighted rate of return of down 3.8%. And I am happy with these results so far. If I look at where we started in December of 2024, the S&P 500 is down almost 10% in that time. So we're outperforming the S&P, which is always good. That's kind of the benchmark that I like to look at. And here are the companies that we've invested in. A little less than half of them are up, but the other half are down. Companies that are doing well so far are British American Tobacco, Hims, Adobe, ASML, Capital One Finance, Crocs, and Canadian Pacific and Natural Gas. The companies that are doing the worst are DocuSign, Google, and Zeta. The one that surprises me the most is Google. This company is looking so strong. This is one that I'm very tempted to double down on. In fact, I'm thinking about doing a video where I go through my existing holdings that are down and decide which ones do I want to double down on because they're even cheaper than what I thought they should be when I initially invested. And then which ones, if any, should I pull the plug on? If you'd be interested in seeing a video like that, let me know in the comments. But for now, I'm continuing to invest in companies that are value companies, but still have growth prospects. The method in this video is finding companies in a growing industry or sector and then finding value companies within that industry. But there are other ways of combining growth and value. If you'd like to see another method, you can check it out right here. Hope to see you there. Cheers. Oh, this is a good one. Henry McKenna, aged 10 years.